what are you bullish at?
We moved from DeFi 1 to 2.0 today and probably heading to another 3.0 in the coming times.
Will we make money into it? And if yes, then look how we're going to do it.
Exit path to liquidity for the investors, for any angels that are coming in, the VCs.
But still, we see in the industry there is a lack of expertise. All right, now we were given a green light to start this amazing panel. We have the most diverse, the most international panel in the history of Web3. So we're excited to share some of the findings. We're trying to find the next Web3 unicorn. So we will begin with the simple findings of who are these incredible panelists, like 30 seconds to present yourself. I'll start like really quickly. My name is Konstantin Kogan. I'm a CEO of TDX and also a partner in TDVC. Please.
Yeah, good afternoon, ladies and gentlemen. This is Lu Chang, the founding partner of Arcanum Capital. We're early stage VC backed by Tether and Tim Draper.
Hi guys, so myself Vivek Mehta, I am heading the marketing and deal flow and investments at New Tribe Capital. We are UAE's second most active VC firm with around 250 plus projects in our portfolio, and we are pretty much sector agnostic. So, yeah.
Hello, everyone. My name is Laura Cornelia Inamedinova, and I'm Chief Ecosystem Officer at Gate.io, as well as Principal at Gate Ventures. And Gate Ventures is the venture arm of Gate.io Exchange. We do early stage projects, anywhere C to pre-seed, and we mostly focus on infra, stables, DeFi, and PayFi.
Hey, I'm Mass, Rain and Coffee on Twitter, research partner at Main 11. We're based out of Amsterdam, and we've been investing since 2017.
All right, we're committed to make this fun, dynamic, like no BS. So let's go right into it. So let's talk about the metrics, right? A lot of founders here, we know that the market is starting to rebound, and let's discuss practically what are you looking from the projects? What are the most important metrics or criteria? Let's do top 3 for each person. You want to start, Lishan?
Start from me? Okay. So I think deep down inside, I really agree that the founder and the founding team are the most important criteria of the whole project. The founder's caliber really defines the nature of the projects, and their quality defines the ceiling of the company. So besides the quality of the founders, I think second, what we're looking for is the product market fit. It's usually like early stage founders, they don't know how to pivot. But when they see a signal, they try to grasp it. But in deep down inside, you really need to find out what is your product market fit and what the users need the most. Yeah, so that's the 2 criteria we're looking for.
Thank you. Vivek?
Interesting. Pretty much agree with what you said, but apart from that, what we actually look into is the product market fit, like addressing the market, what is the TAM, what is the target audience, and what is that problem that the product is actually trying to solve. So we try to cut down the the noise around. A lot of the founders just want to ride the wave. Like when there was AI, they wanted to build an AI product. When it's a deep in, they want to pivot around a deep in product. So we don't budge around those founders and look for more integrated founders and teams, as she mentioned. So that is one, definitely, like a real problem solving and a great solution that they are catering to. And the second is a long-term vision. So they better be building something in the longer run in a particular vertical, and that is catering to a mass audience. So that would be 2 of our X factors, to be honest.
Thank you.
So, Konstantin, to answer your question, I think I need to take one step back and kind of educate some of the founders in the audience, what is a VC investment? So, as a VC, you're investing in a very, very risky assets, which are founders. Usually you're betting them only on the idea on a very, very early stage, and you're expecting huge multipliers. Because if you want, get 20, 30% yearly APY, yield-bearing products. If you want to get 2, 3x in a couple of years, there is a lot of hedge funds doing that. So in the end, you're coming to VCs and you're asking for them give you money for basically what I call it is a high-risk loan. Because you're not betting your some sort of collateral, you're betting your reputation. Because if you raise capital and you fail, they're not going to be deploying again. And all of VCs do due diligence on the founders, especially if they have a bad track record. So you come in and you ask for this high yield, high risk loan, and what do VCs care about? Only one thing: will they make money? And it's not going to be 10%, it's not going to be 2x, they're expecting 5 to 10x return. Is it possible or not in this market? That's a separate conversation we can have, but it's high multipliers. So every sentence, every word, every slide you put to VCs needs to answer this question. How are you going to take their money and multiply it? And that you can show in numerous ways, through your track record, through your tokenomics, through your go-to-market, advisors, and so on. But in the end, the first metric we look as a VC, will we make money into it? And if yes, then we'll look how we're going to do it.
It's a pretty loaded question. I'd say it depends on the stage of the project. So if you're looking at a pre-seed, seed company, metrics are pretty hard to come by. Often it's just an idea. And then you fall back to the founder point, and that's what you're investing in. If it's a Series A company, you're expecting some sort of product, some sort of metrics. This is easy. If it's DeFi, it's TVL. How easy is it to monetize that TVL? But I think it all comes down to sort of the founder at the end of the day. And then also just like original ideas. I think there's a bunch of stuff that is just copy pasta, and that's not that interesting. You know, it could be the 15th Aave fork on the 15th L1. Okay, hard to sort of get metrics there. But I think it's very dependent on what stage of the company you're looking at.
Brilliant. So I hope that was helpful for anyone who's going to pitch afterwards to the guys. Now let's talk about the
Who cares
tokenomics.
about the founders who are like, just give me the money?
Yeah, like this is, we're going to, 23 minutes left. We're just going to make it clear for everyone. Now let's talk about the tokenomics, right? A lot of people try to bring the utility to the token that's like, you know, they spend hours modeling risk management, etc. By the way, I want to do a plug for my colleague Rishabh, who developed the AI tool for that, right? By the way, this is work really hard on this. But still, we see in the industry there's a lack of expertise. Not many people understand market making, how to actually design the long-term tokenomics, because that's their first project, right? And it's almost like going public. So what are the specific, like maybe red flags or things you're looking when you're looking at token utility and token metrics? We can go in different order if you prefer to, by the way.
Sure, I can go first. Just general tokenomics.
Yeah, how do you analyze tokenomics? What's your approach?
I mean, you have to also think about this from like a legal perspective. I mean, you could just make a security, and that's a great token. Revenue goes to the token, but like, there's a bunch of legal loopholes you have to go through. So that's one thing to look at. I also just think about like how much you're actually selling of the company. So like, you don't want to be selling 45% before token generation. We've seen this happen over and over and over. I try to sell as little as possible. Obviously, that's hard. You want to raise money, and sometimes you have to raise a low valuation. But sell as little as possible. I think proper vesting schedules for both investors is very important. I also think if you actually want to have a community involved, I think just doing public sales are quite smart at the moment. So Legion, Echo, and so on. Having most of the tokens sort of centralized in a couple of funds is not very smart.
I want to add a couple of things. So first of all, probably 80% of token projects don't need a token, especially if you're a B2B, which I would say 99% of B2B projects don't need a token. And founders use token for additional liquidity fundraising because they don't need to give out debt equity, or they just hear these stories in media. This guy have raised X amount of millions with a token. So instead of going traditional Web 2 VCs and actually showing traction, showing market fit, I'm gonna just slap a token and like YOLO in the conference. Unfortunately, that doesn't work. Number 3 is you need to understand that everyone, investors, angels, your community are gonna dump your token, especially in this market where there's no liquidity. So if you launch and your token does at least a little bit well, they're gonna dump it straight away to get some sort of capital back because nothing is performing and they wanna cash out some capital. So then you need to plan your tokenomic in a way that whenever you have token unlocks, you're gonna have enough buy pressure from the community, usually thanks to whatever marketing strategy you're doing, to sustain it. Because otherwise, we can have this really bad market as we're seeing right now. Tokens launching, you see 1-2 green candles, usually done by market makers, and then a lot of red candles. Or projects delaying airdrops, even changing tokenomics down the line, just not to get unlocks. And then, of course, everyone's unhappy and there is a different conversation. So think, do you actually need a token? Probably not. And maybe you just build a great company that has a product, has a users, is a revenue and then profit positive company, rather than go into whole this journey of doing a token. Because again, token holders and community and users are usually two the very different audiences that you need to tackle. Have hassle, spend 2 years of your life, and then you say like, well, yeah, we didn't work out because the market is shit. No, you just shouldn't have done it.
By the way, like maybe we'll mix this question with another one. You mentioned that most of the projects don't need tokens, which I think we probably could agree. Like there's a lot of like tokenomics done not right, so maybe it's better off if they would be with just equity and with token warrants as a possibility. So maybe you can also, Vivek and Lishang, you can help us to understand how do you look at the projects that are pure equity and the tokens is optional, so it's not guaranteed. Would you still invest, yes or no? And if yes, what are the criteria?
I think it pretty much depends on the fund strategy as well. Like for a fund like us, we only invest in SAF models, and very little, like only 1 or 2% of our investments would be into safe models where we are investing in actual equity. Because the thing with equity is most of the crypto projects, as she mentioned, they are not here for the longer run. They are just here to ride the wave, or else, you know, we don't want to associate ourselves with an equity project which you don't know how it's going to do later. So with token, you also have some sort of backing at least that you can back out later. So that's one thing. But adding to what she said, like when it comes to tokenomics, few things at the prima facie that we look into is the primary structure of how they look, how they're aiming to back their launch, how they are aiming to go to market with this tokenomics. There was this, I'll just give you it in a quick example. There was this one project, of course I won't take the name, but the unlock of the team was way earlier than it was for the investor. So that clearly says that they wanted to dump the token all, and then that would leave investors empty-handed. So we try to keep ourselves safe hands from such projects. So that are some of our red flags, to be honest. And yeah, so supply, tokenomic structure, and a good go-to-market strategy. That would be some of our X factors, we call it so.
Yeah, firstly, I totally agree with Laura that not all the projects need a token, and also not a token projects need airdrops. And hey, Ashley! Haven't seen her for a while. Yeah. Yeah, we're gonna get to you later. Yeah. So back to my topic. For example, some of the portfolio invested, they are pure equity plays. One from New York called Hi-Fi, one from Mexico called Radium. They are doing purely global transaction and settlement. So you can imagine those companies, they don't need any token. They're just playing the tube business. The transaction from China or Korea go to Mexico, and Mexico settle with US dollars. Instead of dollars, they use stable coins. So they're acting as a New York bank. So that kind of business is lucrative, and even they don't IPO or get M&A, they could pay us by dividend. So we don't need a token for that kind of institutions or companies. But if you do need a token, you really need to design it intricately and well to hold the sell pressure and also make it desirable. Because if you want to have innovation in the token matrix design, remember, innovation is not sexy if it doesn't ground it with the real use case. If the users are gonna dump it, or if they sell the token, they're still gonna use your product, which means your product's good, and your company can survive on that level, yeah.
You join us in a fun time when we're about to talk about the red flags, right? So this is, what is the most fun red flag recently that you discovered in the project?
Okay, jumping right in. I think it's interesting based on what Lucia said about tokenomics in general. I would say in current market conditions that a red flag that just stands out immediately is not understanding how your tokenomics are going to impact a listing strategy. So typically, if I'm doing any kind of venture bets or due diligence and analysis on a project, if we're going to be putting a check in, you know, understanding that there is an exit path to liquidity for the investors, for any angels that are coming in, the VCs. How are you going to sustain this sell pressure long term if you don't have an open strategy for existing liquidity in the open markets, if you don't have significant vesting schedules or any way to dampen the impact of liquidity, if you've done rampant airdrops or point farming campaigns and don't understand what the actual impact of that is on the open market itself versus just trying to generate massive, social side bots, blowing out your Twitter, getting a lot of users in your Telegram and Discord. These are like very surface level metrics, but most projects typically start with this without understanding the implications of what that means to have those users have tokens, what kind of sell pressure that's going to lead to. And this all revolves around tokenomics. And as a red flag, I feel like majority of projects in the space right now don't understand the dynamic of what you're doing when you're trying to aggregate a community, when you're trying to aggregate a user base, and what actually that leads to in the end in a listing environment. So, sourcing and hunting deals, I think it's incredibly important to look for founders who understand the implications of onboarding a community, onboarding customers, onboarding retail, what it means for the trading of your token. And tokens are not equity models. We don't trade on PE ratios. We don't trade on cash flow. So there has to be a strong understanding of, yes, I have a product, yes, I have tech, yes, I have users, maybe I'm generating fees and revenue, but is that really going to lead to a multi-$100 million token without the right metrics and sustainable approach to a listing strategy and the subsequent sell pressure that you're going to entail? So typically projects don't think about that, or they've got very surface level understanding of how that works in practice. That is a major red flag to me, to invest without hearing the overall tokenomic strategy and listing approach to, what is the post-listing environment for a 2 to 3 year post-listing window when all the investors are going to be unlocking over that period of time. And also, do you understand the dynamics between where we are in a current bull market cycle, the liquidity that's available to you at the moment versus in a bear market condition when you're getting unlocks and you're going to be driving down the price even more with subsequent unlocks that you're getting on a monthly basis, on a linear basis, et cetera. So, tokenomics in general, I think, are a rampant part of red flag calling out, and yeah.
Okay,
Hope I jumped in quickly.
Destroyed most of the tokenomics.
I'm just going to tag on to that. I think
you have 30 seconds, Max. Okay.
Okay, yeah, I'll be quick. Red flag is thinking the token is the product. I think the greatest
Yes,
investments
100%.
we've ever done, the token was never in discussion until way later. I think focus on the product first, and then you can sort of shoehorn the token in if you even need one. I think talking about tokens constantly, especially if you're pitching to a VC, obviously it depends on what kind of VC you're pitching, but at least for us, that's a major red flag. I would not focus on the token at all. It's not important, at least not for now.
Yeah, just my 2 cents, I 100% agree, because at the end of the day, it's financial engineering. It's a very, very nuanced skill set that most of the founders who are coming from product background or development, they just don't have. So it's good to have your partners, whether it's VCs or advisors, who can help you build the models, risk management, and build that up separately. Now we have 11 minutes left, so let's do the blitz, right? Let's talk about the positive aspects of VCs. Because we always talk about doom and gloom, that everything is bad, red flags. Let's talk about what are you bullish at? Let's imagine you're in the closed room and you're talking to friends. There's no one here, So essentially, the two trends or verticals that you are personally very bullish, that you would invest, you think this is the future and this is what's going to bring the next trillions of liquidity, or that's going to practically change the world through Web3 innovation?
Probably a tough question for everyone, I think. But yeah. So I think I'll answer it in a very generic way. So we look at, as I mentioned, there's a problem, then there's a solution. We look at it that at what scale can this solution be solved? So if you see, previously we had computers, then we had laptops, then we got to mobile phones, and probably now AI took over. We have AI devices. So you can see where this is heading. So AI could be an answer to that, but at the same time, real AI, not like random AI agents that people are talking at the sake of conversational AI agents or just like text creators and not them, but real problem-solving AI agents. That is one. Then actually the basis layer of or infra layer for stablecoin and payment solutions. So that is something that we believe will be the next thing that will go big, because the way finance is transforming today, we move from DeFi 1 to 2.0 today and probably heading to another 3.0 in the coming times. So I think DeFi is going to go big. So that would be the stablecoin infra, or in general, the payment stable.
So AI and DeFi, okay.
Well, I think instead of picking the specific verticals, I'm going to say my prediction for the general trend. There are two of them. One is that I think all of us, VCs, love to back products or projects which are already generating revenue. So if you can self-sustain, not burning VC money at the beginning, we'll be very pleased to support you, to help you to grow faster. And the second is that, so according to Darwin's theory of evolution, we love to back the founders who know when and how to pivot. Because, the evolution theory is like, species change hundreds of years and adapt to the environment. But in crypto, in the Web3 world, the adaptation maybe happen in weeks and months. So how can you identify the opportunity and real product market fit and really pivot and be flexible and move fast? That's the quality we're looking into, and that's kind of the entrepreneurs we're trying to write a check with, if they really know how to cope with the tide and evolve and change and pivot and then lead the trend. Yeah.
Great point, great point.
Revenue is the king, okay.
So up to a couple of months ago, we saw a huge correlation between stable coins and then money flowing into Bitcoin, all the other assets. Whereas now, stablecoin usage is increasing, even let's say there is a lot of outflows. And our analysts are predicting that stablecoin usage is going to grow and grow and grow. So we are very bullish on the products that success directly tied to the increase of stablecoins. And that could be yield-bearing products, PayFi, it could be either in DeFi. So anything around stablecoins, not stablecoins itself, not the issuing of stablecoins, but platforms around it is the #1 thing we're looking into right now. And if you're building anything in that space, like literally just please grab me, because this is what I'm mostly looking into.
I'll give an example of something I spent a lot of time on end of last year. Specifically what I called opinionated application. I wrote a bare article on this in December, and it's the idea that you can utilize underlying infrastructure to build better applications. And I think the best example of this is Hyperliquid. So Hyperliquid prioritizes cancel orders and post-loading maker orders, which makes it a hell of a lot easier for a market maker to market make efficiently, which means you have better prices for the end user. So that's something I'm very excited about. It does take a hell of a good team to sort of utilize underlying infra to build something new. And then I'm still excited about DeFi. I use DeFi every day, and I think it's one of the clearest PMFs of crypto is decentralized finance.
I've got 3. I think it's all picks and shovels infrastructure related. So anything revolving around improving UI UX on Bitcoin infrastructure, wallets like David Marcus's Lightspark, things like this I think are incredibly useful. And as we move into a space where more institutions are obviously putting this on their balance sheet, there needs to be more sophisticated tooling in that regard. The second would be revolving around permission-based systems. So we saw legacy tech around this, around things like Hyperledger Besu and R3 Corda, but I think migrating into a current enterprise stance of management tooling and things along the lines of Fireblocks for across just the entire gambit of token projects in general will be much more needed across the space. And then thirdly, I think robotics is going to be an interesting sector over the next 4 to 8 years, 1 to 2 cycles, based on the convergence of multi-discipline narratives with AI, with DeepIn, with RWA. I think it brings about a really interesting space to explore for Web3 and the participation on that side as well.
Beautiful. We have like incredibly efficient panel, which I love it. So maybe we have even some time to say like how people can contact you. Like, so what's the most efficient way to like some here? Obviously, they can come up after the panel and talk to you, but after.
Can I teach the founders how to approach VCs in a most effective way? So first of all, never cold DM them, ask for the introduction. You definitely know someone in the space who can do the introduction. That's gonna go much more thorough down just sending a cold DM. When you approach someone, 5 sentences maximum. Hey, I'm building this. This is why it's relevant. Fact about the team or about the product, why it's so incredible, and what's the competitive edge. What is the asks? That means valuation, how much you're raising, and who is on your cap table, whether from investors or angels. Please don't come to any of these VCs and start telling, 5-10 minute story of like whatever you're building, how it's no, 5 sentences. And then if it's interesting, VC will ask you for your details, send them the blurb afterwards. That's it. It's very efficient. It lets you to connect with more VCs, and you're not wasting VC time, especially when they're trying to be polite and listening for 10-15 minutes, knowing it's probably not a fit. And it's okay if it's not a fit, that's fine, but build that relationship on efficiency, because then maybe it's not a fit for me, but maybe Constantine can invest, or New Tribe Capital can invest, and I can refer it to them. But be very efficient and save your time first, because here you have probably 20, 30 VCs, and you want to talk with everyone, so don't cannibalize one VC's time.
I feel less strong also.
Yeah. Yeah. So I generally suggest founders for a very small, very much similar, but a 300-character approach. So 300-character approach is basically if you cannot summarize your pitch in 300 characters, you can't pitch. It's very straightforward. So you had to start off with a very one-liner of who are you, what are you building, the problem that you are solving, and yeah, then you can maybe summarize in a statement if you have somebody on cap table, you got any backers, or something like this. That is very straightforward. I feel LinkedIn is the official way to approach, but otherwise, yes, warm intros works the best, more than a cold DM does.
Totally agree.
Yeah, warm DM, like you probably come through a friend, there are more than 80% chances that you'll hear back from any of us, and I think all of us agree to that.
Yeah, just to chime in real quick. Please don't stack buzzwords without clarity. That's such a pain for us in the call or reading the deck, because we want to know who are using your product and why they're using it, right? So just indicate that with full clarity and also articulate your vision. I mentioned about flexibility, adoption, and move fast, but move fast and pivot without losing your vision. That's also important. Yeah.
Menz?
Yeah, I mean, I have a little bit of different view. I think for me at least, I'm also more on the research side, but I do investing as well. I think talk about what excites you. I prefer somebody coming up to me and talking about something that we both have in common, which is crypto. It could be a specific infrastructure thing that we're both excited about, ordering of transactions in a block, for example, and that usually turns into a friendship, and then that could turn into a pitch. I think the best way to approach people is natural. I think if you just come up to me and say, I'm building blah, 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 I'm raising this, for me, that's a little bit, whoa, that's a lot. I prefer just a natural conversation about something that excites you, and I think that's a better start to a relationship.
I think from my side, I prefer immediate conversations to have some kind of POC or MVP in hand already. Everyone's got an idea. There's millions of ideas out there. If you already haven't put enough faith into what you believe in to execute and build a product in advance to show me what you have conviction about raising funds for, then I'm not so interested in hearing about the millionth idea for how to spin something out. So having a tangible product or at least something mock-ups I think is very important from just an early stage, beginning the conversation to get the ball rolling, and then directionally where we can help with pointing you towards best go-to-market, et cetera, from that side.
Beautiful. I think it's very easy. We're going to even conclude earlier to be the most efficient panel ever, right? And if you feel that you're a Web3 unicorn, you can just come up and use all this valuable advice that you just been given and just apply it on the spot, okay? So give a round of applause of this amazing VCs. Thank you so much for your attention.